Top Chinese officials confirmed last week the People's Bank of China is about to be radically redrawn. No more emphasis on financial levers with Chinese characteristics. The new plan calls for the central bank to buy bonds and communicate through interest rates. And it better start communicating fast because Chinese bond yields are sinking all over again, as is China's yuan, both offshore as well as onshore. The plan appears to call for the PBOC to become like the Fed and ECB. And that's a very troublesome sign. And not because, as some have claimed, this means China's about to unleash QE. That's not it at all. So what is really behind this sudden shift? Well, there's a monetary truth that's known across the entire world that no central banker dares speak of, at least in public. When the banking system is functioning and performing, the economy hums along, markets function well, and central bankers appear all-powerful. Once the banking system stops performing, the economy falls into the toilet, markets become more chaotic, and all of it reveals the truth about central banks. They're entirely superfluous. They take all the credit when banks are doing the work, and then suddenly they have to be reformed when banks aren't working. It's all a game of smoke and mirrors, but one that has finally caught up with the PBOC. There was a time not all that long ago when China's central bank was the envy of the world, the envy of its peers. Well, that time began to change once the dollars started to run out. And once the dollars started to run out, suddenly even the People's Bank of China had its transmission start to be questioned. And that's what we've been hearing a lot over the last several years. What's wrong with monetary policy transmission? When they start bringing up that term, what it really means is the central bank says it's going to do this and executes a policy in order to do that. But in the real economy or the financial system, it doesn't have the intended results. Think about the Japanese and their 20 some odd QEs. Every time they do a QE, it's supposed to create inflation. It's supposed to create easing and accommodation. But in the economy and the banking system, we find that nothing is ever eased. Nothing is ever accommodated. Now the Chinese are finding the same problem for their own system. Suddenly the PBOC needs to be reformed. Earlier this year, this issue of transmission mechanism was brought up in several places, but one that was summarized in a research report from BNP. It said, a recent study found that China's monetary transmission mechanism has become impaired since the pandemic, and it really goes back before the pandemic. The severity of the problem is illustrated by the absence of a sustained recovery in the credit impulse, which they define as the ratio of new credit flows to the system as a share of GDP. This key economic leading indicator remains weak despite rounds of monetary easing. There's that term again. Central banks claim that they're easing when nothing ever is eased. And we see that in things like interest rates, fundamentals of interest rates, which, by the way, is exactly what we're going to be talking about this coming Friday, June 28, 6:30 p.m. Eastern Time, Eurodollar University's webinar on interest rate fundamentals, launching our anniversary sale. Now, it's important to understand where rates are actually coming from because the mainstream views on them are just all wrong. In this webinar, it's just a glimpse of what I write every day at our deep dive analysis, as well as the daily updates in my daily briefing. And behind both of those, we have memberships available with all of the background material. Now, you can sign up right now for a webinar on interest rate fundamentals. There's a link in the description, and I'll let you know about Eurodollar University's anniversary sale once we launch it after the webinar. So I hope to see you this coming Friday, the 28th, 6:30 p.m. Eastern Time. Sign up below, link in the description. This idea of China's central bank buying bonds actually started several months ago at the end of March when the South China Morning Post published what seemed to be some obscure speech or a reference to an obscure speech given by President Xi Jinping last year, which reportedly said that China's central bank needs to focus on bond buying. What SCMP reported was, it appears to be just a matter of time before China's central bank pulls out a controversial monetary policy tool that it has not used in more than 2 decades, following newly publicized instructions from President Xi Jinping. With the world's second largest economy at a critical juncture of fueling growth in its bid to become a global financial superpower, a new book details some of Xi's thoughts on finance dating back to late 2012. And of course, many people took this right away to mean China's about to unleash QE, when that's not it at all. This is not about QE. This was the first hint, first rumor that we got that the PBOC was first of all being questioned by top authorities to the point that they were starting to direct a change in its operation and its operating behaviors, which of course raises questions about why it would need to be reformed into something else in the first place. And the answer is pretty obvious. Because despite the policy easing, the constant policy easing, though the PBOC does say that its monetary policies are neutral, but despite what seems to be policy easing, rates that only ever go lower from the central bank, loan rates that only ever go lower because of the central bank, it doesn't lead to the desired results in the real economy or the financial system, as we've been talking about for the last several years. Credit growth continues to decline very sharply, record lows in outstanding loan stock, total social financing that continues to disappoint month after month after month, and none of the easing or accommodation seems to be making any difference. Thus, questions about the PBOC's transmission mechanism. So if the PBOC is going to be transitioning itself into something else, what does that actually look like? Last week, current PBOC Governor Pan Gongsheng gave a speech at a forum in China where he basically set out that this reform agenda for the People's Bank of China, that they are going to be buying bonds, but they're also going to be selling bonds. They're going to use bond buying in open market operations increasingly as their means to essentially try to control interest rates. And the reason they want to control interest rates is because it's all about communication. It's less about money and money supply. It's less about credit and influencing banks, and more about signaling to banks and the general economy about what it is that central banks would like to signal. Exactly what the Fed or ECB or any other Western modern central banks have become. Their communications tool. As Ben Bernanke said about a decade ago, when he admitted that central bank policies were 98% talk, he admitted the other 2% is just crap. But essentially, that's what central banks are. They're communications tools because they don't really influence money. That's all the banking system. As I said before, when banks are performing the way they're supposed to perform, central banks are viewed as the top level of monetary technocratic competence. When banks no longer perform, suddenly they have to be signalers and communicators, not monetary agencies. So what Pan said last week, traditionally being quite attentive to the indicators of financial aggregates, we have made continuous improvements and adjustments. In recent years, specific quantitative targets are set no more in our monetary policy for the growth rates of financial aggregates such as M2 and social financing. They have been replaced by qualitative descriptions such as, quote, being basically aligned with nominal economic growth. So they can't really define the relationship between money supply and actual economic outcomes. Therefore, it makes no sense to target a money supply or total social financing because they can't seem to influence it anyway, and that target doesn't seem to have any real impact on economic circumstances. This sounds exactly like what the Federal Reserve was discussing 1970s, 1980s, what Alan Greenspan eventually admitted to in March of 1991. All they can do is move around interest rates and hope that it all works out for the best. And the work out for the best only works out when the banking system is performing. They have to reform themselves when the banking system does something that was outside of their control and really outside of their understanding. Back to Pan. We can also continue to refine intermediate variables for monetary policy and gradually weaken our focus on quantitative targets. They're completely transforming here. When the growth of money and credit has pivoted from supply constraints to demand constraints, it obviously runs against the law of economic performance if the emphasis remains on quantitative growth. He's making some weird arguments here. Or even the obsession with aggregates exists. Financial aggregates are to be viewed more as indicators for monitoring, reference, and projection, and the role of interest rates in economic regulation should be more highlighted. Because a short-term interest rate is something that central banks can actually heavily influence, versus this weird money stuff that they can't really monitor and regulate. They can't have a direct impact on money they can't actually define nor really monitor. So in the changing landscape of basically China, and really everything about the Chinese financial and banking system, the People's Bank of China is saying, well, what can we control? What can we do? Well, we can become like the Fed and basically move around interest rates at the front end of the curve. And maybe that will be enough to signal our policy intentions that the rest of the economy falls along. And that's where this emphasis on bond buying actually comes about, because bond buying in open market operations, it is widely believed, helps central banks influence interest rates in different spots on the curve, but certainly at the short end. So bond buying is about transforming the PBOC from a monetary central bank into the Western communication style of central bank. Let's control, or let's think we control an interest rate and use that interest rate to signal what we want to the wider economy. But in order to signal an interest rates and really to have that heavy influence on the front end of the yield curve, that also requires the PBOC to reform some of its policy levers too. Less emphasis on the one-year MLF or medium-term lending facility, more of an emphasis on a corridor style of control for the very short-term money rates, which is something the PBOC has been working on. It's sort of like the policy arrangement that's in place in Europe. And that's what Pan said that they're going to be continuing to move toward in China. Central banks usually use interest rate corridor as a supportive resource in steering short-term interest rates, binding money market interest rates into a certain range, and that certain range is defined by central bank policies. China's interest rate corridor has now taken initial shape with the SLF rate as the ceiling and the rate on excess reserves as a floor, very much like Europe. The width is relatively large, which is helpful to leverage the role of market in pricing and stays resilient and flexible enough. Now here's the key. We will gradually include the purchase and sale of China government bonds on the secondary market in our toolkit. And over a certain period in the past, the injection was passive through funds outstanding for foreign exchange. Since 2014, when the Eurodollar started to go in the opposite direction, such funds declined in amount. We have acted proactively to inject base money through open market operations and the MLF, among other tools. In other words, he's basically saying, the Eurodollar did the policy work for China. As the dollars were surging in throughout the decades of the 90s and the 2000s, and really up until around 2011 and 2012, the PBOC didn't really have to do anything. It was entirely mechanical. It could focus on its quantitative targets because everything was being done by Eurodollar banks flowing in Eurodollars to Chinese banks, and Chinese banks doing all the things that Chinese banks needed to do in order for China to transform itself economically. And everything seemed to work because of those external money flows. But once the Eurodollar stopped coming in, this silent depression era, it has forced the PBOC to try to become a substitute to those dollars coming in, and it hasn't worked. Over the last decade, the PBOC has been more internally accommodative and in more internal easing, especially in 2016. And it did not restart China's economy, nor did it help aid in the transformation, the rebalancing to a more internal-led economic dynamic. Instead, China's economy continues to slow and slow and slow and slow because the dollars represented the way the world used to work, globalization, and as the dollars flowed out, that was a paradigm shift reaching China, the silent depression. And the PBOC found it was not a substitute for that system. So Pan basically comes out and admits this is exactly what's happening. China's central bank is going from a monetary agency, what we all think of as a central bank, to something like the Fed, which is just a communications tool. What he said was, an important feature of the modern monetary policy framework is that central banks can communicate with the market and the public about policy considerations and prospects in a transparent, clear, and timely manner. Enhanced transparency will make policies more understandable and authoritative, and the market will hence have a stable expectation for policy trend in the future and adjust its decision-making accordingly. In this way, monetary policy adjustments will achieve multiplier effects. This is the communications toolkit that everyone else uses. The PBOC has become just like the Fed, or is about to become like the Fed, and that's not a good thing. We got an example of everything we're talking about here, this questions about transmission, just recently. Over the last couple years, really going back to December of 2022, the PBOC had ramped up its accommodation with a program that raised the level of bank reserves. They've started to grow at around a 7-8% annual rate around December of 2022. And that kept up all throughout 2023 through the reopening failure into the stimulus period on into the end of the year. And it didn't really have any impact because here we are in 2024 and China's economy is looking even worse than it had when it was back in its lockdown days. Even more questions, more problems in real estate and the property sector, the economy that's even less responsive to fiscal as well as monetary inputs. Everything says no accommodation, no easing. Given how all of that was unfolding, you can see why Xi Jinping might say we need to try something else. We need to at least try, maybe we can signal through interest rates because everything else that we're doing isn't actually working. And as I said before, the reason it isn't working is because the banking system isn't performing the way it's supposed to perform. Credit growth has slowed way down, way more than had been anticipated even in this deleveraging era. But essentially, credit growth has completely gone way down. Record lows in outstanding loan growth. Again, I mentioned total social financing. The banking system is not performing. And now the central bank needs to be reformed because it exposes the truth. What is it the PBOC actually did all this time? It was the banking system that made China into what it was. And I don't necessarily mean Chinese banks when I say banking system. As China's economy becomes even more questionable despite everything that's been done to try to stabilize the situation, as the real estate sector gets worse and worse and worse, of course the financial variables also display that. Why do you think the PBOC is interested in suddenly controlling interest rates and using them as a signal? Because as it currently stands, China's bond rally has reignited, pushing interest rates even lower, which many people understand is not a sign of stimulus. Low interest rates are instead a signal of low growth and inflation expectations. The PBOC has actually admitted this. That's why they've actually threatened to sell bonds into the marketplace because they don't like the signal that China's bond market is sending to the rest of the world. They're trying to make it seem like everything's under control. This flight to safety, the demand for safety and liquidity is the opposite of the message Chinese authorities would like to send. It's not just China's bond yields that are continuing to decline. We also see the same thing in China's exchange value, the currency exchange value, CNY as well as CNH. CNH crossed 730 to the dollar for the first time since November 10th earlier today. CNY continues to fall, 726.57 at last check. That's the weakest since last November too. Even the PBOC is weakening the currency's midpoint or the midpoint central parity. All of the signals and communications are going against the Chinese. So in one sense, it kind of makes sense that China would reform itself and redraw its central bank to try to be a better communicator. So what Pan Gongsheng did last week during his speech was basically confirm that China's PBOC is indeed being reformed, radically reformed to become more in line with Western central banks. Out with monetary tactics and monetary programs and anything monetary, no more quantitative targets. Those don't seem to work. And in with communications, more influence over interest rates as a communication tool. Let's become like the Fed and ECB, as if that's really something to try to strive for. And the reason for this is really simple. When the Chinese banks were working well, when they were doing what they were supposed to do, because the global banking system was doing what it's supposed to do, China's economy was the envy of the world, and it made the PBOC the envy of all the other central banks. But the PBOC wasn't really doing anything. The banks were doing all the work, and they were just simply taking credit for it. As the banking system globally started to take a step back, and really several steps back, that eventually led to Chinese banks doing the same thing. Suddenly, the PBOC and all its assumed power was revealed to be nothing more than the same smoke and mirrors. And so the PBOC needs to change itself again to try to stay in the game. Rather than affect the money supply and liquidity and all of that kind of stuff that central banks are supposed to do, what we all think of, instead they're going to communicate through the interest rate channel and signal not just to the banking system but to the wider economy and hope that maybe this one will work. When banks hit the wall, that exposes the central banks as impotent and unimportant. And the banks hit the wall in China quite some time ago. But this isn't just about Chinese banks nor China's central bank. There's a lesson here that it applies to the rest of the world and the silent depression. China's yuan is not the only currency that's falling against the Eurodollar system, and I talked about some of the other ones, as well as central bank rate cuts in the video link below. Check out our webinar this coming Friday, link in the description. As always, I thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. Until next time, take care.